Hello, I'm Vadani Ariam. This presentation is about gross profit and stock in a business. Gross profit is shown in the income statement as a figure after deducting all the associated costs in the production of a product or services from the sales that are called the gross profit. In another format, gross profit equals sales minus cost of goods. After the gross profit is calculated, all the general administrative expenses and the tax payable deducted to get the net profit, which is obtained from the production of profit and loss for the specified accounting period. The net profit will be the revenue of your business. Gross profit is the amount of total revenue minus cost of goods sold. The other costs like rent, rates, stationery not considered when calculating the gross profit. Gross profit is equal to revenue minus cost of goods sold. The gross profit margin ratio. It is the most critical ratio. It is used to assess the relationship between profit and sales. Gross profit times 100 divided by sales, that is equal to gross profit margin. Gross profit ratio is used to assess the financial health of a company. What is stock? In accounting, the term stock means the goods you hold on to hands and that to be sold to the customers. Otherwise, it is known as the inventory. The ownership of the shares of a company is also called stock. Then the inventory held for the process of the production for sale. The cost of the stock includes purchase price and the other labor cost, production cost, transportation and other handling charges. But the general and administrative costs cannot be added to the cost of the stocks. The valuation of stock, the assessment of stock, leftover is the cost price of the stock, purchase price of the stock, or the current market price, whichever the lower. The first stock of a company is a debit balance in the books at the beginning of a financial period. It was debited to the stock accountant at the close of a previous fiscal period. That's what is the closing balance of the previous period is the opening balance for the current period. That's what I'm trying to explain here. The debit value of the old account taken as a trial balance figure when the final reports prepared for the current period. The two dates of the opening and the closing stock should indicate so there is no confusion. The amount in the stock at the beginning of a period transferred to the trading account at the end of the period. Stock accounting double entry. You buy some stocks for say $500 which you want to sell later at some point. The double entry will be debit asset and credit cash account. In the event you want to return some of your stock to the supplier, the debit is made to cash and the credit is made to the stock account. Cost of sales. What is the cost of goods sold? Cost of goods sold is equal to the opening stock plus what you are buying, the purchases, plus minus the purchase returns. That means you bought some goods and after that you decide to return the goods. That's minus the purchase returns plus direct expenses, that is expenses incurred in ordering the cost and buying the cost and storing it, plus the direct labor, that is the labor you paid for the manufacturing of the goods, minus the closing stock, that is called the cost of goods sold. Opening stock, the stock you have in hand, purchases the goods you buy during a specific period. Direct expenses may be transport expenses, staff wages and storage. Direct labor, the wages that you pay the manufacturing labor. Cost of sales is the cost of the goods sold. It consists of the total purchases plus the first stock less the closing share, give you the figure for the price of sales. The primary purpose of the trading account is to find the gross profit or loss for a stated period. The gross profit is the difference between the sales and the cost of goods sold. What are the mistakes that you could make to increase the gross profit? Wrong amount of trading expenses debited to the profit and loss account. If you miss some expenses, that will increase the gross profit. Outstanding expenses left out, not included. Some future payments you have not included in the specific period. When wrong sales entries are made, you increase the sales entries, so that will increase the profit, gross profit. Purchased and returned goods debited to the supplier and in the closing stock. Goods returned by customers included in the closing stock, not credited to the customer. If the goods sold but not delivered are included in the closing stock. So you have to, for all these to get a proper answers, accurate figures for everything, you had to maintain the stock. This stock control is important in a business. That's what this is all about, to get the actual gross profit. I hope you like this video and understood the concept in this video presentation. Thank you very much for watching it. Thank you.